You're looking for institutional bearish sponsored trades. What you're going to be looking for is order flow to be bearish firstly, or order flow to appear to want to switch to bearish conditions, which you will be able to see from price action. All right. So in this example, I want to start looking at the S&P 500. I want to analyze this chart from the top of the wick, which is this top right here. So this top right here, right? And you'll notice that the price of this market forms a high here at this down close candle. Let me make that longer. At this down close candle. Right. Now, when the market reaches that high, the market rallies away from that high, from a low. And the market rallies higher and then falls from another low. Market structure shift has occurred. Now point your attention to this. This expansion created an impulse swing in the market downwards. As you can see, the market moved from this high all the way to this low right here. I lie? Is that what's not on your chart? It was an impulse swing. Now, for a bearish institutional setup to be sponsored, order flow needs to be bearish. So now we know order flow is bearish. Now, when that impulse swing is created, the market needs to come into a premium of that range. Okay? So remember, I've told you multiple times in this mentorship that institutions sell premiums and they buy discounts. So when you draw a range from that high to this low, with the bottom portion being the discounts region and the top portion being the premium region, do you see that the market, after hitting this low, rallies into a premium? That is the premium above the portion above the 0.5 level. And what happens when it comes to the premium? It is quickly sold down. You have this candle right here, followed by this, and another down close candle, and you have about 4 successive down close candle bars. Okay? So the first thing you look at, order flow. Is order flow bearish? Check. Secondly, what is the range? If we're looking for a short setup, then price should come back into the premium of that range. So it's price in the premium, check. Now, the next thing you want to look at is what are the liquidity pools inside of that range, okay? So in that impulse swing that was created, when price declined from this high to this low, where are the areas on the chart where we know that there's going to be money? Well, let's observe it. When the price formed this high, it rallied downwards. Then it rallied high, so it declined downwards. Then it rallied higher above this previous high to form a new swing high, which you can see here. Right? At this top. Then price declined. So when price declined like that, you are aware of the breakup block pattern. I told you there's only 2 ways the market is going to turn. At any swing point, there's only 2 ways the market is going to turn. It's either the market will move in an up, down, swing high, and then violates the old swing low. This is the breakup block pattern, right? And then the only other way that the market can turn, you take a look at this, look at your charts. Every swing point is either it's this pattern or it is a swing high, swing low, a failure swing where the market tries to go higher than the top but fails and then falls lower. So in this situation, what scenario do we have? Do we have a breaker or do we have a mitigation? We have a breaker. So you know that there's going to be liquidity sitting at this low because buyers bought this low And now that the price has fallen on this down close candle, the buyers who bought this low are wrong for buying and are losing money. So if price can come back to this low, they'll be happy to close their long positions for break even and get out the market. At the same time, injecting sell orders into the market. So that's the first pool of liquidity, guys. So you can mark that swing. In that swing, that is the first pool of liquidity. Now the next pool we're going to look at is the fair value gap that was created. So after price rallied and took out the buy stops that were resting above this high, we saw a big displacement in price. And you see this candle's low, then you see a big body candle, and then you see an upward candle that has a high. So there's a gap formed, right? So the gap is this range. That's your fair value gap. That is another pool of liquidity. So when price rallies into a premium, yes, but price also rallies into a liquidity pool, a premium array, which is the fair value gap. So there are going to be sellers inside of this fair value gap. And what happens when price touches this fair value gap? Boom. Sharp decline. Okay? So let's repeat this process on another impulse swing. So after price violates this low that's made here, it goes and forms another low all the way down here. So from this high right here to this low, that's another impulse swing. Order flow is bearish. Identify the range. And you see that price rallies back into the premium section of the range. And when it rallies into the premium section of the range, what happens afterwards? Sellers quickly capitalize on price, and price declines. So we have order flow, check. Impulse swing was created. What's the range? If its order flow is bearish, then we should get to a premium of the range. Check. Order flow is bullish, get to a discount of the range. Check. So now the next thing, after finding out what the range was what are the liquidity pools? What are the premium liquidity pools where sellers are going to be? Well, at the top of this range, we have a fair value gap created when this low of this down close candle was created. Then we saw an imbalance in the market with this candle. And then we see an up close candle succeeding it. So that creates a fair value gap. Okay. Essentially. Now, price rallies lower. This in itself is actually a breaker block. Alright? So price made this run up here. Came down, made a swing low, rallied higher, then fell through. Do you see it? Price made this low here, rallies up to make this high, declines back down. Then another rally, buyers capitalize on price again, forcing price higher. Price takes out all those buy stops resting above this high, and then price declines. So there's going to be liquidity here because all the buyers who bought here are now losing money when price made this swing downwards. So if price can come back to this low, they will close their long positions for break even and get out or even enter short. So sell order should come to the market. So that would be another pool of liquidity. Now, even within these candles, there are fair value gaps. Fair value gaps here. Fair value gaps here. You can see how the low of this candle and the high of the next candle is an imbalance. and another one lower. But you see that when this range is created and these liquidity pools are created, price rallies and reaches back into the premium of that range. And where does it mitigate? It touches the fair value gap, rallies further, goes into the breaker block, which is this black line here, and we see a decline in price from there, and price declines further, and this process repeats itself. So take a look at your chart, look at order flow, look at the range, liquidity pools inside of the range, and you know that if order flow is bearish, institutions are going to sell inside of the liquidity pools and they will buy when price gets out of that range.